Today we'll continue our conversation with Dave Hill by talking about your best loan options for 2023. You will never get a better education on the history of interest rates, the benchmarks for a healthy economy, and whether an adjustable rate mortgage is your best option for 2023. That's coming up. Hi, I'm Wade Hanson. I've been selling luxury real estate in Minnesota and Wisconsin for over 23 years. My entire career has been spent protecting my clients from misinformation and unethical practices by those not looking out for their best interests. This podcast will give you the raw truth about everything real estate so you can make solid, informed decisions about the biggest investment of your lifetime. This is the Raw Real Estate Podcast. We've known each other for, I think 20 years now.
Going on 20 years.
Yeah. I have a ton of respect for you, what you've done in the mortgage industry.
Me too.
And which not only in the industry, but as an individual and just your whole mindset around success and everything else. So I thank you for being here. I think you're going to have a lot of great insight for everybody. We're in just a very, very, I guess, uncertain time right now, I think, for a lot of people. So I want to talk and dive right into that. But I first want to kind of talk a little bit about 2022. For me, this was one of the craziest years in real estate, right? I saw probably the highest of highs and not quite the lowest of lows, but some pretty low times in the real estate industry. And we've seen rates, of course, double. That's been a big talking point. And just a lot of changes in our market. So tell me what you've been seeing from a lending side this year.
Sure, absolutely, Wade. So first of all, thanks for having me. It's great. We have known each other for 20 years, so I've had a good view to your journey and your success. And it's been awesome to see your commitment to excellence and commitment to mastery in this field, especially when we had the run with the apprentice. That was especially fun, hosting some of those viewing parties. So you did such a great job there. Little did we know that you were apprenticing under the next 45th president of the United States. And he was going to become one of the most controversial figures in
Definitely, especially today.
Yeah. So when I reached out, we've known each other so long, but there's been gaps in there. And when I reached out to you about 6 months ago, it was born out of the idea that this market is changing, and it's going to change possibly in a radical way. Now, you and I have been through 3 recessions. We've been through the Great Recession, the subprime crisis, the foreclosure crisis. I didn't anticipate maybe it being that bad, but I thought it could be. So, in Napoleon Hill's great classic, Think and Grow Rich, he talks about the mastermind group. Sun Tzu in The Art of War says, go to war with a multitude of counselors. And so I thought about the industry, and I thought I'm going to put 6 people together that I really trust and appreciate their insights. And Wade, you were on top of the list because, the transactions we've worked on together, problem solving, a lot of us are good problem solvers, right? Our industry, you have to be successful in this industry. But you anticipate problems before they happen, and you solve those problems. And so I wanted to study how your brain worked a little bit, and I even told you that.
That's kind of scary.
It's taking a while, but I'm getting some insights from you because you are an elite in this industry, and you're an advocate for your clients in a way that is inspiring. It's refreshing, and the idea that you can solve problems before they happen is a great skill to have. It shows that you've mastered every of the steps in the transaction.
Thank you.
So when we talked about it, so this is really just one in a series of discussions you and I have been having. Yeah. And I'm sure we're going to provide some value for people who are listening, at least stimulate some thought on the things that they should look at behind, the clickbait or the sound bites of the Fed raised rates. So we'll talk about what happened, why the Fed took the action that they are taking, what the consequences of that might be. So if we look at, let's go back maybe to the pandemic, right? So the economy before the pandemic was finding its footing. The Trump administration believed in zero interest rates, right? So they're not supposed to pressure the Fed, but they wanted the Fed to reduce. And about 2018, we did have a little bit of a rough patch, and so the Fed did reduce the Fed funds rate. So, to back up for a minute, should we talk about what the Fed funds rate actually is?
Yeah, I think it's good to give a little bit of background and insight and kind of a little 101 and
Yeah.
50,000-foot view of what that is and how that affects real estate and interest rates.
So the Federal Reserve Bank was established by Congress in 1913, I believe. Woodrow Wilson, I think, was president then and signed it into law. And they were established to control, monitor monetary policy, to create stability in the banking system and in the markets. And they have a dual mandate. And when we talk about this dual mandate, it's so interesting.
It is.
So they have a dual mandate to create price stability and to create full employment, right? So think about that for a minute right now in the world we're in. Mm-hmm. So inflation is running, almost 8% still. Unemployment, they claim, is 3.7%. Okay, we'll talk about unemployment and how they measure that because I don't believe it's 3.7%. But let's just say for a moment that it is. So they've got what they consider full employment, but they have high inflation. So what tools do they have to create their dual mandate to bring price stability without hurting employment? Interest rates.
Right.
So the Fed funds rate is probably the most important interest rate in the world. It's a benchmark rate. It's the rate, I believe, that they set for banks to pay interest to each other for borrowing funds overnight if they're short to open business. So prior to the pandemic, all banks had to have some reserve capital. But with the pandemic, the FOMC decided to allow banks to borrow everything down to zero in their funds. So sometimes they would open the next day, they would need to borrow either from the Fed window or other banks, right? So the bank sets that interest rate through their FOMC committee meetings. And they meet 8 times a year. There's 12 members to the board, and they decide policy. So the only tool they have now to work on inflation is the interest rate.
Right.
So they've been increasing the interest rate over the series of the last 6 meetings, actually 7. So March 17th, they increased the Fed funds rate 0.25%. May, 0.5%. June, 0.75%. July, 0.75%. September, 0.75%. And just in November, another 0.75%. So when they have this dual mandate to keep unemployment low, which is 2.5 to 3.5%, I think is the number they shoot for, and price inflation down, how did they do that? By raising these interest rates. Now, if that works, that's great because maybe we can keep employment, stable and price stability. Do you remember when it first, the inflation first started to hit at the beginning of the year and they called it transitory?
Mm-hmm.
So it never was. It's frustrating to see the incompetence sometimes in our federal government because when they sent the stimulus checks out, when they created PPP, they should have known at that time this could be possibly inflationary and maybe made some adjustments to the, from zero on the Fed funds rate to 0.5% or just signaled something that we're doing something to offset inflation, but they didn't. They were behind the curve, and so now it's kind of a catch-up game. But if their idea is to raise interest rates, to bring prices stable, to bring inflation down, how does that work? It only works if you hurt the economy, if the economy is contracting a little bit, if companies aren't hiring, if companies aren't expanding. Mm-hmm. So it's not like they're on the cutting edge, they're on the bleeding edge right now. And if it works, if employment stays stable, if the economy stays good and prices come down, we might have a great 2023, 2024. If it doesn't, if it goes the other way, then it's kind of a crapshoot to see how it's going to play out. So we'll discuss a little bit of that too as we continue this discussion. But I was just fascinated by this dual mandate and what they have to try to accomplish to bring some stability to the markets and price inflation.
Especially today, because those are the two things under the microscope right now, right? Unemployment and inflation. Mm-hmm. So I want to jump in just for a minute because I think a lot of the consumers that I deal with they think that every time the Fed raises interest rates, that means mortgage interest rates are going to coincide and go neck and neck with whatever the Fed does. So if the Fed goes up half a point, they think interest rates will go up half a point. Can you just talk a little bit about that and how that affects interest rates and what your expectations are with rates moving forward?
Yeah, absolutely. So the Fed funds rate does directly affect some rates, like the prime lending rate. Now, the prime rate is a rate the banks use to borrow money to their best customers, for example. It's also an index for credit cards and for home equity lines of credit. Usually there's a margin, to the prime rate. But the prime rate, I think, is at 7% now, based on these Fed increases. When they started, I think it was 3.75. So you can see almost a direct correlation. When the Fed raises the Fed funds rate 0.5%, prime will go up 0.5%. So it does affect home equity lines of credit. It does affect that. But it indirectly affects mortgage interest rates, right? Because the mortgage market is a huge market. There's institutional investors. The Fed itself was buying $40 billion of mortgage-backed securities through the pandemic. They just tapered off, I think, to zero now. I think they own like 2.7 trillion of mortgages. So there's a correlation, there's a ripple effect anytime that the Fed raises rates. And always, I've noticed over the years, if you chart this, the first few Fed rate increases always affect mortgage rates to the high end. They go up too. And we saw that with the first 4 Fed rate increases. But the 5th one, mortgage rates came down a little bit. The 6th one, they came down a little bit. And that is because the institutional market is anticipating these rate increases probably are going to work. And eventually the Fed will have to reverse course because they could put us into a recession. Well, if we're in a recession, what is the Fed's tools then?
Right.
To reduce interest rates.
Right.
So they're always forward thinking. And so when you're a consumer and you're looking at, well, should I lock my interest rate? Should I float my interest rate? You have to go way deeper than the sound bites or the clicks. You have to work with somebody, if this is an area of interest of yours, you have to work with somebody that studies this daily and can give you, good recommendations and good advice on what to look for, what to do. Now, the 30-year fixed rate mortgage does track the 10-year treasury most days. There's all kinds of things that have skewed a normal market where the Fed hasn't intervened to the degree that they have over the last few years. But normally the 10-year treasury is a good benchmark to look at to know if the 30-year fixed rate is going to go up or down. And then the shorter term treasury, or the 1-year bond even, would be a good benchmark to look at if adjustable rate mortgages are improving. But there's a dynamic on the treasury market right now that is called an inverted yield curve. Familiar with what that means?
Not as much, no.
Okay, so that's a big topic because a lot of times when rates are high, people will say, well, look at the adjustable rate mortgage. Maybe there'll be some savings
Right.
there. And usually there is. But when investors feel that interest rates today are higher than they're going to be in the future, the short-term interest rates are actually higher than the long-term interest rates.
Interesting.
And that's what's happened today.
Sure.
Is the yield curve, which is normally, if you invest your money for a year, you're probably going to get a lower rate of return than if you invest your money and lock it in for 10 years. Now, the treasury market's liquid, but
Sure.
just based on normal, if you are looking for a long-term investment, you're probably going to get a higher rate of return. But it's not the way it is today. So it's really interesting that. So Fannie Mae and Freddie Mac, they're the government-sponsored entities that create the liquidity for mortgages for banks, mortgage companies, credit unions, to be able to have an endless supply of funds to do mortgages with. Well, they're actually in receivership now since the subprime crisis, but they're profitable again, and they're great, institutions for creating stability in the mortgage market. But if you look at their pricing, when you sell mortgages into their pools, their adjustable rate mortgages are about the same as the fixed rate. So there's no spread anymore where it really is that dynamic. I remember in 1991, recession of 1991, rates were at 9%, right? That was doing my first loans in 1991. At
I was a freshman in high school.
Yeah. So it was 1999 though. You were licensed, right?
I got
'Cause
licensed in
remember when
99,
we
yeah,
talked
yeah.
back then. So rates were 9.5%, but it was an extreme yield curve. The short term, the 1-year Treasury and the 10-year there was a 3% spread. So we were selling. The FHA had an adjustable rate mortgage that started at 4% less, than where the market was. So it offered some real savings. And if you think about what happened since, you were a genius to take an adjustable rate mortgage in 91, 92, because they came all the way down. With an adjustable rate mortgage, you share the risk with the lender, right? And that's why you typically get a lower starter rate. You get the rate, whatever the rates are today, with a bit of a discount, to it, because you're sharing the risk, but you're also sharing the reward. If rates come down, you can track down without having to refinance.
So I want to interject there for a minute because that's really a hot topic right now. I'm seeing a lot of lenders really push hard on adjustable rate mortgages again, which scares me because it was the ARMs that got us into a lot of trouble back in the '08 crisis, right? I mean, you've been doing this for 30 years. You're working with the number one lender in Bell Mortgage, and you've helped thousands and thousands of families. If I'm somebody that comes to you today, says, Dave, should I do an ARM or should I do a fixed rate? What's the advice you're giving somebody right now?
Well, each situation is individual, so we always look at mortgage banking from a financial planning point of view. We get involved with our customers to think about how sophisticated of investors are they, right? Can they outperform their mortgage interest rate in the markets? Have they been doing that? So we look at everything, but when it comes to that kind of advice, let's say this is a home rate that they're going to be in for 12 years, right? 12, 14 years. Kids, this is their home for the kids to go through high school. That's a little different conversation than somebody that says they're in a starter home for 3 to 5 years. So I would not advise a 1-year adjustable rate mortgage anymore. It's just too many things uncertain.
Yeah.
It would have to have some big upside. But for somebody that says, I'm going to only be in this home 5 years, we would look at a 7 or a 10-year adjustable rate mortgage. And the way they work is that first number is always it's a 30-year amortization, but the first number is what the interest rate is locked in at, cannot change. So for a 7-year adjustable rate mortgage, for 7 years, you don't know it's anything but a fixed rate mortgage. Your plans are to be in the home 5 years. It's kind of a no-brainer if there's some savings there, right? Mm-hmm. If it's a 10, 12-year plan and we're looking at a 7-year ARM and there is some benefit to analyze, so we'll just lay out, okay, over the 7 years, here's the amount that you're going to save based on the fixed rate. Okay, let's say that's $12,000. All right, let's now anticipate years 8, 9, 10, 11, and 12. So adjustable rate mortgages, they always have a start rate, right? They have a index, which could be the prime. For years, it was on adjustable rate mortgages, it was the LIBOR index, the London Interbank Overnight Rate or Offering Rate. But that's being phased out, and I don't know really yet what will replace it by 2023. I think that's going to be phased out. So let's just say it's the 1-year Treasury, that's the index. So that's set. That's something that is going to be around forever. You can look in the Wall Street Journal, you can turn on the news, you can Google 1-year Treasury. And then there's always a margin to that. So usually anywhere between 2 and 3%. So let's say the margin is 2.5%. And let's say year number 8, we anticipate that the 1-year Treasury bond would be 3%. So you take 3% plus the margin, 2.5, your rate would adjust to 5.5%. Let's say it started at 6 today. Well, you'd actually come down 0.5%.
Right.
But we could look at worst case, and when you look at worst case, you look at the caps. There's lifetime and yearly caps on adjustable rate mortgages. So typically, the caps are 2 and 5. So the first year, and that's why as a consumer, you really have to have somebody that can explain the adjustable rate. Because when you talk about the subprime crisis and that ARMs, there is a theory out there that it was the adjustable rate mortgages that caused the subprime crisis. And they contributed to it for sure. But the ARMs that contributed to were these option arms, these teaser rates with great big adjustments very quickly. And they even had adjustments with payment caps.
They were almost monthly adjustments on some of
Yeah,
these,
so
weren't
they
Yeah.
would. They would go monthly, the option arms. And but the payment would be capped. So you'd actually be negatively amortizing. So if your payment required based on the new interest rate was $1,000 or $2,000 a month, but your payment cap said you only have to make $1,000,
Right.
that's why they called them an option arm. You could make the low payment, that's determined by the cap. You could make a fully amortized payment, or you could make an interest-only payment. So as long as home values kept rising, right, I guess you're okay.
Right.
And we'll talk a little bit if you want to park on the foreclosure crisis for a little bit, because it is fascinating. There were so many tells back then, but it's really interesting to look at it in hindsight and see how many people missed these tells. So when you look at an adjustable rate mortgage today, though, there were a lot of lessons learned, and through that Congress enacted some laws and some protections for the consumer, but you still have to be aware of how an adjustable rate mortgage works, because if you just discount it, Minnesotans really, we just are very conservative people when it comes to adjustable rate mortgages. But my clients that have taken adjustable rate mortgages with me have won big time because we've thought it out. We've thought the strategy out. We've prepared for the worst case scenario. And when you think about the caps, then that's how you would look at a worst case scenario. So let's say that in year number 8, it's got an initial cap of 5% and then yearly 2% and a lifetime 5 over the start rate. So then your rate, if it was at 6, could jump all the way to 11.5%. So we calculate that payment, but you calculate it on the new balance. And sometimes the payment doesn't go up that much, even though the interest rate has risen because you've paid down principal. And now you're calculating the new payment off a 22-year amortization based on the new interest rate.
Yeah.
And if somebody is, on a mission to prepay their mortgage and they're going to reduce principal pretty fast, the risk reward can be fairly clearly defined.
I'm so glad to hear that answer. While it was a long-winded, analytical answer, I think so many of these chop shop lenders right now are just getting the consumer excited about a 7/1 ARM, for instance, and just saying, hey, look at your payment is this today. And they get so focused on just this payment, and they say, just marry the house and date the rate. And they're promising them that rate's going to go down over the next 7 years, and they can just recast that loan over the next 7 years. Well, they're not laying all of those different scenarios out there, and they're not doing what's best for the client. And they're also not considering, what if home values go down 10, 15%, and you can't refinance? You no longer have positive equity to refinance your home. They're not laying all those scenarios out there. You're really thinking through things with your client case by case based on that client's situation, right?
Yeah.
So I think I'm really happy to hear that answer, and I know those can get confusing, those ARMs, and I know they're becoming more of a popular product. So it's nice to hear somebody that's been through it and that can educate their client on it.
And I'm so glad you said that about some of the lenders not taking the time to thoroughly explain programs, especially to young buyers. It's frustrating to me to see some of the gimmicks. Another one is the 2-1 buydown that a lot of lenders are promoting without really thinking through it. We'll talk about that if you want, because that one is that's ubiquitous now. It's short-term thinking, and it doesn't make any sense except in really one scenario, the scenario where you can get the seller to pay the buy down. Because a 2-1 buy down, all you're doing is you're subsidizing the interest rate, 2% for the first year, 1% for the second year. So you calculate that interest difference, and you put that in an escrow account with the lender. The lender keeps that and then subsidizes your payment. So if you are using all your money for the down payment and closing costs, and you can get a seller to pay the buy down costs, it can have an advantage in that scenario, because if rates do fall drastically while you still have money in escrow, you've already got some money now to pay closing costs on a refi. So there is one strategy where the 2-1 buy down makes a lot of sense. Otherwise, lenders are promoting that like this is our start rate. People get desperate, times lead to desperate action sometimes. And I want to give everybody the benefit of the doubt that they're just trying to be creative and promote and market. And, you and I have a heart for that. But when they're deceptive in their advertising, it's frustrating.
Yeah.
Because I've seen the 2-1 buy down advertised as if this is our start rate without disclosing the amount necessary for the escrow. So.
Right. It's great information. I appreciate you sharing all that.
Thank you for listening to the Raw Real Estate Podcast. If you have any feedback for this episode or want to suggest a future topic or even possible guests, head to wadehanson.com. There you can get links to my Facebook and LinkedIn pages. And don't forget to subscribe to my YouTube channel to see the video version of this podcast too. Again, thank you for listening to the Raw Real Estate Podcast. We'll talk soon.